Good afternoon. I have the difficult task of speaking to an audience after lunch. Whenever I sit in that audience, I know how difficult it should be. In this 1 hour, I will try to give you some of the things that I learned along the way and how my learnings helped me improve as an investor. Firstly, unlike our previous speakers, I have never worked in the investment industry. I've never held a formal job anywhere. And secondly, I've been an entrepreneur running a manufacturing unit for nearly 22 years. And subsequently, I joined the investment industry in 2009. So most of what I learned was as an individual investor, and I value those learnings immensely. And I think those learnings have definitely helped me significantly even afterwards. I deem myself very lucky that I graduated in June 90 and I joined the market almost before that, a month before that. I had no idea that I was going to become an investor. Unlike many of you who are very clear in your aspirations, you're doing your exams, you're very focused. I had no idea. I used to spend time with my neighbor who was a chartered accountant of many reputed companies in Chennai. And I used to see him do his investing. That curiosity made me learn a few things. And I had a lot of time. And it was that phase of life when you're not sure what you will do other than be a part of your family business. That is when I got hooked to equity investing. By nature, I had a fairly good understanding of how consumption works. And my natural inclination was to buy better businesses because my investing was not supported by my family. Everybody were against investing in equity as an asset class at that time. Investing was seen in a very different way from how it is seen today. So I simply could not afford to lose money. If I lost money, my story was over. So I had to invest in quality and I had some idea about consumption. So the first companies that I invested in were quality stocks. I bought 3 stocks which basically helped me believe that I could do investing. The first one was HDFC Limited, it was a 100 paid share. The second was Ponds, which later became part of Hindustan Lever, and the third was ITC. These 3 companies were the companies that I bought first, and subsequently all the companies that I studied were Cadbury, Reckitt, Procter & Gamble, Gillette, all very safe companies because that was the place to be. But when you're young and learning something and you have the fire to learn, you start interacting with a lot of peers, and those peers have a very different worldview. The friends I had were doctors, so they started talking about pharma. There were people who were investing in Sun Pharma at that time, and I had no idea about that subject. It was very complex. But still, you start exploring new things. And then I had other friends who wanted to do only value investing and study only brick and mortar businesses. So I would go along with them and we would study companies and we would visit companies, do a lot of scuttlebutt, and that basically gave me my first window into value investing. And we had time on our hands every evening from probably 5 till about 11 or 12. We would be only discussing markets, trying to read whatever we could gather. The papers used to come in the evening. The pink papers would come only in the evening, and that's how we got our experience or knowledge. So there was always a lag between what Bombay knew and when we knew those same things. There was a lot of scuttlebutt we used to do. At that time, it was just the beginning of liberalization. Within a year of my coming into markets, you had 3 things. You had de-licensing. A lot of industries were de-licensed, which meant that companies could increase capacity significantly. And there were a lot of industries which were changing dramatically. Exports were going to boom because of the kind of incentives we had. You had the balance of payment crisis. The country badly wanted dollars. So a number of teams started opening up. So it was a very good time to do scuttlebutt, visit companies, understand who is into exports, who are going to get those incentives, and try to form a view on multiple businesses. So the period up to May 1992 was a very exciting phase because we could visit so many companies, we could learn about industries, and there were no constraints. Unlike people who work in an industry or in a asset management company like you do today, you are only going to do what your firm wants you to do. We had no such constraints, so we were free to see whatever we liked. So it was a very free environment in which we learned. But 1992 was not scary. It was something which is indescribable. It's beyond description, because what happened in 1992 May was a crazy thing. And most people who saw us take interest in stock markets were kind of coming to us and saying, see, I told you, this is not the place to be. After May 1992, the Harshad Mehta crash. So it was so traumatic that my mentor told me that you should not do any trade for 1 year. So from May 1992 to 1993 June, I took a sabbatical. I was in IIM Bangalore doing a 1-year management development program. But there also, I was busy learning equity research. That's the first brush I had to a lot of literature on equity research. The IIM Bangalore library, as you all know, is a fantastic place to learn. So I was able to do a lot more structured learning in that 1 year. And when I came back, I decided that I would set up a proprietary equity research desk, because I didn't have a choice. I still had to run my business, so I could not join any company. Chennai was not a place where there were people who were willing to, employ anyone as a research analyst or advisor or consultant. Those were not the days when people would pay you for research. So there was no question of monetizing what knowledge you had. So the only option I had was to set up a proprietary desk and do my own research. And that's how this journey got a little bit more formalized. But it was a very, very good phase to learn, because during those few years, I came in touch with many peers with whom I still remain very close. One of them is Mr. Anil Kumar Goyal. Subsequently, Sanjay was another person with whom we started interacting in 94, 95. And we used to form a small group and exchange our ideas on multiple industries, more oriented towards the value style. So that was a phase where I was deeply into value investing, because, again, it helped me not to lose money, it helped me to survive, and those were very, very difficult times. 95 to 99 was probably a very, very tough phase, because 90 to 93 it was very easy to make money. We got out of the Harshad Mehta scam with minimum scratches, not even bruises, and kind of saved ourselves out of that. But 95 to 99 was a very, very difficult phase to make money, because the markets are going nowhere, valuations are very, very low. But it was a very good time to learn a few things. One, how do you develop simple principles by which you evaluate businesses? How do you study sectors? How much can you pay? And we were a very, very tight-fisted group of investors. So we would buy companies very, very cheap. And that 4-year period basically taught us a lot to buy businesses cheap. Then you had the 2000 tech boom. Interestingly, in 1992 and in 2000, I had not participated in any of the sectors or stocks which were in the boom. For example, the tech boom passed without my buying any tech stocks. I was completely out of the tech boom. I never invested in any tech company, because the valuations were much higher than what we were comfortable buying. We were buying stocks at very, very low PE. It was unthinkable for us to buy an Infosys at that time. We never went anywhere near that. Similarly, we were completely away from any of the Harshad Mehta stocks. So that habit has stood to this day. In every boom, we have not participated, whether it is the 2008 boom or in 2018, we had exposure to some of the sectors which really did well, and like teams like small caps, because that is where we have always been. But even there, we were trying to get out. We were not trying to participate in the boom. So generally, my tendency has been to stay away from sectors where there is too much froth, where there is too much excitement in the market, where people are very, very excited and willing to pay a higher multiple. This tendency is what I think has helped me survive this long in the market. And this tendency has also made me look closer at companies, evaluate their financials on a continuum, take learnings in one cycle to the next cycle. And this phase between 1990 and 2000 was very, very important because the number of companies that we would have studied closely was very, very high. The number of companies which we tracked during the decade was also very, very high. It is very unfashionable today for people to track so many companies, but those days we did it. I don't know how we did it, but we still did it. And that basically taught us so much to think beyond the immediate also. When you buy companies very cheap, you also try to see how the value will get released. There were so many businesses which were expanding in that phase continuously. There were so many companies which raised capital at high prices in 94 during the GDR boom and then lost 90% of the value by 99. You will be surprised that most of the companies of very, very reputed groups of today, like the Murugappa group, were a part of this. And we were tracking all these companies from 94 all the way to 99. That's why I said that phase was a very, very important phase for us in learning. And we were able to think beyond the immediate and buy those companies when the valuations came down. So despite not participating in tech boom, we were still able to make money in the stock market. Now, today we say contrarian investor, we give nomenclature, we try to box people into stereotypes. But this decade was a time when we did not worry about any stereotype. We were very free to learn what we like, and that learning has helped immensely subsequently. In fact, we never thought about how it will help. But looking back, that learning helped us a lot. Another important thing we learned between 95 and 99, and I credit Mr. Goyal a lot for this, is to think big. How do you buy a lakh of shares in a company? How do you put 1 crore in a single stock? How do you buy a significant position in a company? How do you buy 1% in a company? All these thoughts we were able to try out, and as a very, very young investor, I was able to try it out for two reasons. One, because of the constant engagement with him, and the second reason was that stock prices were so low that we were able to buy quantity. Today, stock prices and valuations are so high that you have to put out a lot of money to buy large parcels. Then it was not so. It was very easy to buy large parcels and to learn how to scale our bets. So in that sense, that was a very, very important phase, 95 to 99. Then the tech boom happened. We had no tech stocks in our portfolio, but that did not mean that we were not punished. We were definitely punished because post 2000, our stocks also fell. And in fact, they fell more than tech stocks. But this phase helped us a lot because we learned to scale bets, we learned to right size our positions, and probably that is also the phase which taught me to do portfolio construction. Today I see a lot of people very keen to know which stock to buy. I think that's very normal for people in the first cycle. For me, in the second cycle, what I learned was that you should learn portfolio construction and pay as much attention to that as you pay to stock selection. And that phase definitely helped us. That long bear market was a time when we learned a lot, experimented with growth style of investing where you bought quality stocks, experimented with value style of investing where you bought cheap, but those stocks also turned out to be growth stocks in the future. So what you learned helped you a lot later when those businesses accelerated their growth. So this phase between 90 and 2000 was a space where I had a lot of freedom to practice and evolve both the styles and understand how much each one works for me. By 2000, I was not clear still what style I should do, and I was still doing both these styles. I would say that the period from 2000 to 2010 was when I was able to evolve a little bit more than the previous decade. First, I started organizing my thinking. I started to simplify my thinking into themes, which helped me to focus on a few things. Some of the simple themes at that time were fertilizer. There was an imbalance in fertilizer. We started looking at fertilizer. We started looking at how to participate in industrial stocks without buying capital guzzling companies. So we bought many of these consumable businesses at a very early stage. Organizing your thinking is very, very important. I think a lot of us are today going behind themes which are very popular, but it's not just important to organize your thinking into teams, you must also look at teams which are not popular and spend your time when they are unpopular so that you will be ready to buy them when they must be bought. You can't start thinking about a team after it has run up significantly. And I see that a lot of people are doing this, but this was a phase where the markets gave us time and it was a very, very early stage to think themes. I'll give you an example of two themes which I ideated at that time. One was the chemicals theme and the other was kitchenware. So there was this stock called TTK Prestige, which I think did an IPO at a market capitalization of somewhere between 130 and 150 crores. And in 2001, the market cap fell to 21 crores. That was the market cap of the company. The revenue was close to 100 crores. The market cap was 21 crores. I felt that the kitchenware theme was very, very early because until then TTK was seen only as a company which sold one product, pressure cooker. Whereas they were selling in America kitchenware, which was not so successful at that time, in fact, but they were developing the expertise to broaden their product range. Even today, when you compare TTK and Hawkins, you will see that two exceptional companies. One company has lagged for 22 years in the kitchenware theme, while the other has managed to move well beyond that theme. So this is something I could spot at that time simply because I could organize my thoughts into a team and then go and do a lot of scuttlebutt, meet the company, understand what they were doing, and we were able to buy large quantities of this stock at the time. I think we must have bought close to 3% of this company for 63 lakhs. That's all we spent. And the seller was Morgan Stanley. It taught us how to buy a large parcel of a stock even when there's a very, very important and reputed institutional seller. But we were very, very early. The company continued to overpromise and underdeliver. I would have held the stock for about 3 years, and in 2004 or 5 I would have sold it around 80. This is another point that I want to emphasize, that in every market cycle you have to extend your gestation of ownership. This is something that I have taken a long time to learn. In the first cycle, I would have held a stock for something between 2 to 3 years. In this cycle, I would have held between 3 to 5 years. And slowly with every market cycle, I have managed to extend the period of ownership, because time is the differentiator in returns. Two people would have bought the same stock. Somebody would have identified the stock. He would have held it through the most difficult phase. But the other person would have come in after this phase and made multiple times more. I gave you this example so that you understand how to deal with an investment if you are very, very early. And this is a problem which, if you are very individualistic and if you are a very, very independent thinker in the investment world, you will constantly face this problem. You will be early and you have to learn to deal with that process. You have to learn to deal how to manage yourself. Another important thing which I want to say, and Mr. Bhattacharya mentioned in the morning that growth and value are conjoined to the hip. If you are a value investor, it's important that you find growth in the stocks that you buy. That is how you will be a very successful growth investor. I don't think the two schools are different. You start as a value investor and stay long enough to be a growth investor. This is my personal belief. So finding growth in value happened here. I mentioned TTK Prestige. There's another stock which I bought. I bought it for 24 rupees and it came down to 13 rupees, 10 paid. This was SRF. Sanjay is very familiar with SRF. A lot of work we have done. There was a demerger and then a merger, so many corporate actions. We were so early in this stock that after we bought, the stock lost almost 30–40%. We were not wrong, but dealing with being early is a very, very important learning for an investor. You need to learn how to deal with yourself if you're early in an idea, because you will always be early and you must learn to deal with that. And that is something that I learned in this decade. And finding growth in value is the only way you can become very rich. If you are going to be a value investor who is going to buy an undervalued stock and sell it at fair value, a lot of which we did in the previous decade, you are not going to become very rich. You have to participate in the growth phase of that business, and that's not easy to learn because you need to extend your investment gestation and you must evolve your investment process to support that, because if you don't have a process to support it, you're going to run out of patience. You want to sell and find something else. And this is something which you cannot avoid as an investor, because you also have to show returns to yourself. Your confidence has to stay the course and make you do new things. So managing yourself is very, very difficult, and this is something I learned during this decade. Style is also something that you refine. I told you that I did a lot of quality stocks in the beginning, growth stocks in the beginning, then went to value stock, then understood that actually the value stock can also be a growth stock, and then try to find how I can stay long enough. I stay 3-4 years, still it's not enough. Then you understand that you sold and it was not the right thing to do. But you keep refining your style. You start finding what suits you, because you want success. You are able to ideate, but you still need to get the fruits of ideation. Because I have seen friends of mine, and it's a very sad comment to make, there are people who are much better at ideation than many of us, who are not in the market today because they were so early. I'll give you this example. There was this friend of mine who discussed Sangvi mover in Chennai. He discussed it so early, made a loss and got out. Sometime later in 2003-04, I again came across this company. We were discussing it with Mr. Goyal, completely convinced that it's very cheap to buy, and it was the only way we could be comfortable playing the infra boom. I went back to this friend and told him, you told this idea. Now we believe it's a good one. What do you think? He was so defeated that he even refused to look at the idea. He felt so defeated because he had made a loss, he had exited it, and this can happen to any of us. So when you're early, it's very important that you have a process and a style and a confidence which will support you till it is the right time. We made so much money in that stock, but just understand the person who ideated the stock made no money. He made a loss and he quit. This can happen again and again, and this phase taught me that. It taught me to be humble, because I went to this person, I spoke to him, still he was not having the confidence to go back to something which he had done. The market is such a tough place to be, and it can humble. I know a lot of people are almost first timers in this cycle. You've not seen something like that, but trust me, you will see that phase. And when you see that phase, you have to apply yourself adequately. I know a lot of people try to say that I am a growth investor, I am a momentum investor, I am a value investor. I think that one should not stuff oneself into any of these silos. It's very important to understand how you can straddle both worlds, because one world leads to the other. The reverse also happens. I'll give you an example. You may have a stock which is a growth stock today at a very high multiple. Mr. Sundram mentioned that Infosys was at a PEG of 100 PE in 2000. In 2016, I bought Infosys at 12.5 times because I saw it as a value stock. The same Infosys which we avoided in the peak of the tech boom, we were able to buy it at 12.5 times and still make money. So a growth stock can very well become a value stock some other time. I don't know how many of you are aware that through the Harshad Mehta boom and even for a much longer time, Castrol India was a growth stock. Today, if I tell you that Castrol India was a growth stock, you will laugh because most people think it's a value trap. In the 90s, if somebody said that Castrol India would become a value trap, everybody would have laughed at us. But that's the market. The market turns growth stocks into value stocks and value stocks into growth stocks. So you have to straddle both worlds and be comfortable. And I learned this in this decade. And because you're straddling these worlds, both these worlds, your portfolio strategy keeps shifting. Also, your portfolio strategy keeps shifting because there are times when you want to be super defensive, and there are times when you want to lower your defense and become a little bit more aggressive, and there are times when you want to go back to being defensive. This decade was a classic example because 2001 to 4, we were very deeply entrenched in value, and 4 to 7, we went back to growth, and back 7 to 10, we were so scared after 2007. I remember Sanjay had invited us to Bombay for Professor Bruce Greenwald's lecture. And in the lunch break, we were talking, and Mr. Goyal was telling me, I think we should not be sitting here, we must be selling whatever we have. That day was the peak of the market. The day Professor Greenwald spoke was the peak of the market in January 2008. We were in value stocks. We were very scared of the market at that time. But still, when the market crashed, our stocks also fell. So this decade basically gave me an opportunity to scale up investments. I started buying significant positions in companies and being comfortable about owning larger positions, taking bigger bets, creating a portfolio construct to my work, being more balance sheet driven in my investing. And I think that this was the best learning phase for me. These 2 decades of learning helped me in the next decade. How? Let me explain. In 2010-11, I had a very defensive portfolio and I went to an AGM in Bangalore of a company called Fontech. A friend of mine, he had just left Sequoia. He was one of the early friends in equity research in Bombay. So I told him, why don't you come to the AGM? So he came to the AGM, we sat through the AGM, and then I told him, let's go and have lunch. There's a Taj Gateway nearby where I like a particular restaurant. So I went to Karavalli, which is the restaurant, and we were having lunch. So I opened my portfolio and showed him the portfolio. It had all the value stocks because we were scared of losing money. My friend asked me a question. He said, you have done 2 years in the stock market. We are in a bear market. If you can't be aggressive now, what is the use of your spending 2 decades in investing? And I can tell you that was the best lunch I've eaten in my life. Not only it was food for the stomach, it was food for thought. So I told my friend that I will come back to you with something else. That's when I was able to seamlessly go back to growth investing, and I wrote a portfolio and again sent it to him after a week. I sent him a portfolio at sometime 11:30 in the night. He called me immediately, selling all those stocks. I sold my entire portfolio and built a growth portfolio. Where this really helped me was not just in moving quickly from value to growth, but also understanding how to play it. It was a classic moment because at that time the macros were getting worse and the micros, the valuations were improving 2011 to 13. So I was able to sell my value stocks at reasonable price and slowly shift that portfolio back into growth. The important thing in this phase is that I was able to extend my ownership longer. So I held stocks for at least 5 years and I bet only on growth stocks. It was a concentrated portfolio of 7-8 stocks, and I did only a classic buy and hold until the valuation reached a level where I was very, very uncomfortable owning. Until then I just held it. I didn't worry about valuation going above the usual value stock paradigm. I held it comfortably like you hold your FMCG stocks, and I made fewer decisions during this period, and all this helped me because I held the stock long enough. But there was one problem. I was able to sell some of these stocks, but I had huge challenges selling the micro caps because I am not used to selling large parcels to institutions. I have no idea how to sell to institutions, and I had grown significantly, but I had no clue how to exit. So 2018 was a very interesting phase where we were able to sell the bigger stocks, but not able to sell the smaller stocks. So micro caps became a headache. Also, I had not thought about all the attention that you will get. Wherever your name is in one shareholding list, somebody tweets about it, somebody asks you 100 questions, and I am not used to that kind of attention as an investor because always my investing has been away from the public glare. So it was a very difficult phase where you are successful, but still you are not having the freedom which you had as an investor. But this decade taught me to use what I had learned in the previous 2 decades. And also, reinvestment became a huge risk because you have to invest much more capital in just 1 decade. So the process demands were very, very high, and I had to adapt my process. So I took a clean break from all this, and I decided to do 3 things. One is that I created a clear collaboration construct with very well identified people with whom I could work. So a lot of young people, we started working together on a newer way of doing research. And that is something I really enjoyed between 2018 and 2020. So I learned how to work with others, accept ideas from others. And the second thing I learned is not to be the elephant in the room. So I decided that I will not buy very small companies where you hold very high positions, because when you build a 2-3% position in a 200-300 crore company, there's a high impact cost, and after that you are stuck if your decision is not working out or if you don't like the company. So I didn't want to do that. So I decided to avoid larger holdings in very small companies, and I also decided to vacate my home ground at that time, which is micro cap and small cap. So from 18 to 20, I spent my time selling my legacy portfolio. That's exactly what I did for those 2 years. So in that sense, I was completely unprepared for COVID. I was completely unprepared for that event of COVID, and it caught me off guard. But I want to summarize a few things which I learned up to this period, which have helped me in this phase and after. The first thing is something I learned through our discussions with Mr. Goyal, Kaushik, my brother, Sanjay, all of us. And that is trying to time too hard. It doesn't work. This is a graph we just developed like a clock. You can just see which is the best time to buy or sell a stock. This is something which is very, very important, which any young person should know. I want to place this point very, very emphatically here. So we all think that the best time to sell a stock is at the top, which is at position A, right? But most people sell when it is either late at position B or at position C. So then you come to which is the best time to buy. I would think C is a good time to buy, okay? But people want to buy at the bottom, which is D. Nobody does it. Most people end up buying at F, by which time it's probably not the time to buy, right? So theoretically, the best time to buy is when it is at D, but it is difficult to execute. You may not get the volumes. At that time, your conviction may be low, and most of us move our price target lower when the price is at the bottom. It's a natural instinct for us to do. So we learned that you should buy between C and E, and you should sell between F and B. This is something which gives a lot of peace of mind, and your process keeps running smoothly, and you're not trying to be perfect, and you build the desired positions. Why I'm putting this before you is it's very, very important to right size your positions. Most people end up with smaller positions because you're trying to be perfect at the bottom in buying, and you end up not selling even your positions which you built with great effort because you're trying to be catching the top. So I think that you should know when to buy and give yourself more bandwidth, and you should also be willing to start selling a little early so that you sell at the top and even after the stock has peaked. So this is something which is very, very important, which I learned in those 2 decades and which I have been using subsequently, which helped me a lot when I have to build larger positions either as an individual investor or as a professional investor. This next one I want to talk about is very, very important because we worship success. We take success for granted, but we don't see the genesis of success. Because see, there are times when we buy a bad stock and we lose money. It ends up as a losing bet. That's the first quadrant. Well deserved. There's nothing to regret. You made a bad choice, you're punished. But there are some times when a bad bet becomes a winning bet, right? There could be people who made money in Brightcom. There could be people who made money in a Suzlon. There could be people who made money in stocks which don't hold on to value, right? There you're lucky, but there's a problem. You start thinking that that's a way of investing. And you start going after bad bets simply because you had winning bets in bad bets. It's like kachra stocks make money. There are people who give these theories, right? This is something you should not get in your mind. And this is something which went very deeply into our minds during those 2 decades. Then you have the good bet, which is a losing bet, right? In the sense, you could have bought a good stock, you could have waited 3 years and then run out of patience, you could have sold it, maybe to buy another stock, which you thought was better, and then this stock which you sold becomes a winning bet. That is something we should avoid through our behavior. We need to extend the gestation of ownership. We should be willing to wait longer in businesses where our conviction is high. We should not lose patience simply because time has passed. And it's important for us to identify most of our investments, not all, you can never get all, but a majority of our investments in the fourth quadrant, which is good bets and winning bets. I was very lucky that the 2 decades of work which I did helped me in the 3rd decade to land multiple stocks in that quadrant. And if you ask me what I would ask, I would not even look at performance. I would want to be in that quadrant. That's all I would want. If I am focusing on that quadrant and I am able to find investments which will keep me comfortable till they are successful, that is enough. I know a lot of us obsess about performance and outcomes. I think if you are able to focus correctly, then the outcomes are a question of time and we should wait. These are 2 points that I learned during those decades, and a lot of my learnings came through collaboration with peers. And interestingly, the peers whom I collaborated with are not echo chambers. For example, Mr. Goyal is a very tight investor when it comes to valuation. He would never overpay, and very, very rigid frameworks of what is the right value, and he would adapt his framework mildly. Sanjay, as you all know, I don't need to tell you what is his style. His style is very different. My style is very different. Naren had a very different style. There are other friends with whom we have collaborated over these decades when they were individual investors who all have different styles. Most of the learnings happen when we interact openly with people who are not our style. I hate to work with people who agree with whatever I say and say this is good, that is good. This is not like you're praising the cooking of somebody at home or getting praised for something which you do at home. It's not a mutual admiration society, it should never be. Your peer circle should be completely diverse with people who will criticize you, people who will even scold you. It should be very, very open, and you must be able to exist comfortably in that society and take that criticism. The reason I'm here till this day is that the earliest part of my investing career, I had friends who were very, very harsh critics. They're very, very harsh critics. The way they would deal with an idea would be very tough. To convince them would be very difficult. So to convince them, you work harder and you build your idea well enough before you speak. You don't open your mouth when you just got the idea. Until you formed a proper hypothesis, you don't go out and speak. So the peer circle is very, very important in investing. And I think that today there is a tendency to only move with people who are our type. I think we should move more with people who are not our type. Now coming to the phase which I would think was a tough phase for me, which is the COVID phase and beyond. As I told you, I was completely unprepared for COVID. I had not factored this in. I thought I was going to complete my restructuring and start a fresh portfolio and do things. And we had just started our PMS. We got our license in August, and we had just gotten a handful of investors, collected very little money. We finished deploying money in the last week of February, and March COVID hit. So we were completely unprepared for that. And also, COVID brought a certain disruption in our work, in the sense we are not used to working remotely first. We're used to working face to face with people. And there's a personality thing in this, some people can't work in such environment. I am one of those. To top it, I moved to Kodaikanal. I took permission from the government and moved to Kodaikanal, and I was living there, so which is remote. And we had some health issues in the family and all those things. And that is the time I felt that, okay, I have been investing till now, thinking that I am around to manage a portfolio. What if I am not around? That thought completely took over my mind, and I started reimagining my investing, and I had a complete change in my mindset during COVID. I know a lot of people are busy making money in that phase. I'm not one of those who was active during the COVID phase doing anything. We were just studying businesses, trying to understand what would happen later, and just taking stock. Almost the entire lockdown, that's what happened. After the lockdown happened, we had some clarity. Started again reimagining my personal investing. Luckily, in the PMS, we had very rigid rules, and that's where my basic philosophy of creating products and not making the PMS personal worked. Generally, in the PMS space, every PMS product is identified with the personal investment philosophy of the manager. There is no distinction between the two generally. Whereas you wouldn't say that of a mutual fund. What we wanted to do was create products which would compete with the mutual funds. We were not competing with the PMS industry. So that helped. So the PMS was isolated and I had time to reinvent what I wanted to do. And it was a very, very interesting phase because I was started looking again at extending the investment gestation. Here again, I had done a lot of private market investments before COVID struck. And there again, there were huge challenges. I had invested in a travel company in 2018-19. And 1 month before COVID struck, the company hit the highest turnover and it became profitable in February. We used to have monthly board meetings. In March, we were expecting the company to hit a new high. Business went to zero. And the company needed to be recapitalized. So it was a very, very interesting phase of personal learning for me because I learned to deal with a crisis for which there was no preparation. It came out of the blue, and it was a space where I was intending to do a lot more. Interestingly, what we did in that company taught us much more on investing than I have learned in the previous 2-3 decades. Because an equity investor is an opportunity seeker in the secondary market. You're not a business builder. If something doesn't work, you're going to sell and get out, right? You're going to just sell and get out. That is going to be your response. But here, there's no question of selling. The value is zero. You have to rebuild the business. How do you rebuild the business? You have to recapitalize the company. Not only recapitalize the company, you have to bring the right strategic thinking so that the company survives the crisis where there is no revenue for 6 months and there is expense, and then build market back. Interestingly, last month, the company did revenue equal to 1 year's revenue at the time I invested. It did monthly revenue equal to the annual revenue at which I made my first investment. So these things really shaped my thinking a lot, and I started thinking, how can I own businesses much longer? Before COVID, I would think that if I'm able to own a business for 5 to 6 years, it would give the desired returns. But after COVID, I decided that I would think of what I can own for 10 years. And when you move from 5 to 10 years, most companies which you want to buy or you think of buying don't pass the test. Most of the companies go down. Fewer companies think deeper, think longer. Your decision making process takes time, but your investing is slow paced but oriented very firmly in a certain direction. So that is what I learned from COVID, and my focus has been venturing deeper into the private equity space. I again invested in another company which is a food chain. We invested in during COVID when the company had shut most of its restaurants. We gave capital for the reopening, and that company has also done extremely well. It's turned profitable since we first gave an investment. They did another round, and today the company is profitable. I learned a lot more during COVID than I have learned in my previous 3 decades. These 3 years taught me a lot more because I realized that whatever entrepreneurship I had done suddenly became valuable. I realized the value of those 22 years I had spent running a manufacturing company during those 3 years. 2010-11, the valuation of companies which I picked up large stakes were all 100 to 300 crores, whereas now the companies that I pick are probably between 2,000 to 5,000 crores, which is a very, very different catchment. But slowly I'm adapting and learning how to invest at a higher scale. Why am I saying this, and how is it relevant to an audience like this? Because all of you are going to grow, and you always need to prepare for that growth. And you need to organize your thoughts in such a way that they support your growth as an investor. One thing that has always stood me in good way is the constancy of themes. I always think about teams, and I always collaborate. If you take private investments also, I have a peer group with whom we collaborate. Each one brings certain strengths to the table. We don't have investment bankers in any of the transactions we have done. All transactions are direct with the founders. So we don't deal with merchant bankers at all. We deal directly with the promoters. So we seek businesses, and there's a lot of collaboration that happens. And that is something which is very, very important, because only through that we bring all our skills to build the business. And the whole thinking is oriented towards how can we build businesses. I think that investing, if to be taken beyond a certain point, has to be entrepreneurial. Even if you are not the entrepreneur, you have to think like the entrepreneur and be with the entrepreneur. Only then you can make a significant improvement beyond a certain point. Otherwise, your investing is going to hit a ceiling. Because otherwise, you're just going to say that, okay, now I'm going to do indexing or ETF. When you see a lot of investors who have spent 30, 40 years, and I've seen this with multiple people whom we respect. When the people whom you respect as managers retire and then tell you, I'm only doing indexing, what does it tell you? It tells you that beyond a point, unless you reinvent yourself, you cannot be relevant in this field for a longer duration of time. And this will apply more to the generation of people who are going to follow, because this reinvention will have to happen at a faster frequency than it happened in our time. So it's something that you need to think about and think like entrepreneurs. Don't be opportunity seeking to do transactions which will make you money in 2 quarters or 3 quarters, because that is not going to be sustainable. Because when the markets turn, if you have a phase like 95 to 99, which I think we will, that phase will sort you out, and it will make you lose your faith in yourself and in investing as a craft. So be more entrepreneurial so that you can be with entrepreneurs and grow yourself. This is another important point that I have learned along the years, and this has helped me to protect myself. Patterns and parallels. These are two sets of issues and events which you will see as I explain. First, to the patterns. Very promoter selling. A rush to do QIP. A lot of offers for sale. IPO mania. Insider selling. Employees selling. A lot of M&A activity. Promoters selling out of a company which you are very bullish upon to hold for a long period. Promoter sells out. And very high institutional ownership, very concentrated and high institutional ownership like mutual funds. And falling promoter stakes, where the promoter stake suddenly falls from 50 to 35. What do all these tell you? I am using these patterns today to highlight one point, that these patterns basically are warning bells for what? Can anyone say? It's probably a call to sell some of these companies. You have to be very careful. In a bear market, you can invert these patterns, and you will have the other thing, promoter buying, no IPOs. You can just invert this pattern and you will get a bullish pattern also. In this case, these are warning bells to me. And if you notice, you're seeing all of this in the current market context. To me, I always look for patterns like these so that I am clear where the market is, and once I'm clear where the market is, I get an idea of where I should be. Now to parallels. Parallels are more macro, behavioral in what the investor community does. Sectoral concentration by funds. Today, funds are marketing only small cap and mid cap. Then you have these quant type of funds. Then if you look at funds closely, where their returns are coming from, it comes from very highly concentrated ownership in companies. I can show you mutual funds owning 9 and 10% in a company which has got only 25% public float. 40% of the public float will be owned by a single scheme or a mutual fund house. Now these things basically distort valuations. Suppose the same fund has a redemption pressure sometime in the future, he will have to sell. What you think as valuation today will, as valuation accretive or supportive today, will become a weakness in the future and the same company can trade at a lower valuation than it ought to. Today it is trading at a higher valuation. Then businesses going in for too much diversification. In 94, because companies were able to raise capital in GDRs, they did diversifications. They announced diversification plans and raised money and never implemented the plan. They put the money in treasury, they put the money in real estate. I won't name any companies, but if you go back and learn, you'll understand a pharmaceutical company went into real estate. Why would they do that? Then they raise money saying that they'll do a project and then they'll put that money in their own companies. One company buying another company's share. And then they will diversify into businesses which they don't need to diversify. We see all these trends coming back in the QIP mania that you're seeing today. Then, because the valuations are high, you invent new paradigms of valuation like revenue multiple, PEG, EBITDA multiple. You're seeing all these things now. And as I told you, CapEx plans way ahead of what the company is capable of managing. If you take the chemical space, which was my favorite for a very long time, today you're seeing companies doing far more CapEx in 5 years than they have done in 20. What would all this lead to? Everybody thinks that they do a very big CapEx, then they'll improve the profit pool significantly. Actually, the converse can happen. Because the capacity has become so much, and one guy puts up capacity, competitor also puts up capacity. And once you have so much excess capacity, then the pressures are going to be different. It's not going to be a seamless utilization of high capacity. It's not going to happen. In fact, capacity utilization can even drop sometimes. So we are seeing all these things. These parallels give you warnings, and then thematic concentration by institutions. You have seen this happen time and again because people have bought only one sector, and Sundaram mentioned it. Mr. Bhattacharya also mentioned how people bought only one sector. I don't want to repeat what they've said. These are all parallels that we see in market cycles which are very, very strong warning bells. And I think a young generation of investors and people who are like you who are researching businesses and want to become professionals in the industry must have your own warning systems. To me, parallels and patterns are my clear warning bells, and I always look at them and ask myself whether the risks are going up. Like this, you can check this date, it's 23rd March 2020. We will have days like this. And these were my thoughts. What happened to quality? It has lost so much value. What happened to value? It is being tested for quality. But it is for those days that we must prepare and live. I wasn't very well prepared for the date, but I know that if it happens again, I must be better prepared. And that is what makes me want to do investing for life. Thank you for the patient hearing.